Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I want to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, take a look, see what's going on today. You can follow me at finding_finance, and you can join our community, finding-value.com, where I dive deeper into all these topic subjects, looking for potential investment opportunities and sharing those opportunities with everyone in the community. I do that through midweek updates and through question and answer sessions on the weekend. I look for early entry points that are bottoming using technical analysis, ratios, and market cycles. I also look at sectors and what the commodity itself is doing. So there's a lot of things I look at. And then when I deem it to look pretty good, I'll bring it to people's attention and they can do what they want with that information. If that interests you, special is the coupon code. You can get a 50% discount on the monthly membership and a larger discount on the yearly membership, which is $100 off. So starting with Tim Hack, he says, how's a 1 year gain of 46,000% sound? So Poseidon, which is a nickel company back in 1969, 1970. So Poseidon's share price got up that much in 1969. At the height of the frenzy in February of 1970, the company had a market value of $700 million, 3 times the size of Australia's largest listed bank at that time. I say it will repeat with silver. And this is Poseidon nickel boom bust. The big move in 1969 and a massive move. It's a this is wave one here, wave three, and then wave five. The down waves 2 and 4 here. Then into the nastiest bear market you've ever seen in a very short period of time. And that's markets for you. That's a bubble. And if you read this, it says October 1969, it reports false assay results, shares up to $12. So there is some malarkey going on here, some negative or falsified documents and releases here. Peter Lynch says big companies have small moves, small companies have big moves. I think that is majority right. But what do I try to do? In commodities, the company is more or less a leveraged way to play a commodity. That's what the companies are. There are some times that larger companies have higher cost curves. Let's just say it's a new company, it's coming into production, and most of the time, not all the time, but most of the time, new production is at the higher end of the cost curve. So there is possibilities where a very large deposit is found. It is, let's just say, at the higher end of the cost curve. It doesn't have the ore grades are kind of low, let's say, and it's a larger company. You can still get really big moves with mid cap or big cap companies as long as they are a higher cost producer. But a lot of the times, if the commodity is out of cycle, it's going to be down 90+% from its highs. So in commodities, I wouldn't say that what this quote is 100% true, but it is mostly true. What I try to do is I try to find the companies that are well capitalized, moving towards the bigger companies that are massively out of cycle, and we buy them when they're out of cycle at very low lows. So really what we're playing is a company that has all the assets in the ground and known. They've got infrastructure to produce from it. They're just a higher cost producer at a bad time in the commodities market. All that is a big major leverage play to the upside of the commodity. That's all it is. I'm not playing a small cap company that has no employees, no deposit, no infrastructure, no nothing. That's a lot riskier because they don't have anything and there's no way they can generate cash. A bigger company that's just high cost, well, they can generate all the cash they want as long as the commodity is in a profitable price area. Warren Buffett says most people get interested when everyone else is. The time to be interested is when no one else is. You can't buy what is popular and do well. Well, yeah, because you got to buy stuff that nobody's looking at. I call it ninja buying. So be a ninja, get in there, buy shares when no one's looking, and they won't even know you're ever there. They won't even know. Now, if you're buying kind of more illiquid companies at the bottom of markets, you're going to have to do limit orders and have to be patient to get filled. There's not a lot of buying at bottoms. When you go to sell the stock, I think it's going to be a little bit different situation. Usually at market tops, everybody's all pumped up. There's enough liquidity to dump your shares to the retail FOMO guys over at the local grocery store who are talking about your stock. So at bottoms, yeah, no one's around. You got to do limit orders. It may take days or weeks to fill, depending on the pricing that you want. And then when you at the end, when everyone's buying, you just say, "Here you go. Here's my shares." Mortgage refinance demand spikes nearly 60% as interest rates drop sharply. The average contract interest rate for 30-year fixed rate mortgages with conforming loan balances, 806,500 or less, decreased to 6.4% from 6.5%. The adjustable rate mortgage share of activity increased to 12.9% of total applications, its highest level since 2008. So this is a good thing. Why? Well, I made the comment, look, wait for the mortgage rates to fall, and let's see what the mortgage demand looks like. And this is mortgage refinancing demand. So we're seeing refinancing spike nearly 60% as these rates drop. Now we want to see mortgage applications and what they look like after we get lower mortgages here and see what happens. The residential real estate market is a major cornerstone of the economy and employment. And that's the reason we want to look at this. If we see mortgage applications spike similarly to refinancing demand or anywhere near it, that's a good thing because it means that the economy is strong and they cut interest rates to probably spark this demand. What you don't want to see is you don't want to see interest rates drop and then mortgage applications drop with it. That means you have major issues. Major issues. That's like 2007 and 8, where basically demand dries up at the same time that interest rates fall. That's a recession. That is very bad. Capital flows. When Cathie Wood is making money in markets, you know there's liquidity in the system. This is physics 101. I thought it was funny. Um, I really don't know how Cathie Wood became so popular in 2020, 2021. She was hardcore dogging oil at the bottom of the oil market. And I was sitting there like, guys, this is going to go by the end of the bull market, by the late 2020s, early 2030s. We're going multi-$100 on oil. And she's dogging it like oil's never going to come back. And it's going to go the way of whale oil. I'm like, sure. Sure, buddy. I mean, how could you be so wrong? Um, so yeah, there's liquidity in the system. You can see that her stuff's doing well, and I'm sure this liquidity is finding all the nooks and crannies out there in the market and trying to find a home of where to make money. Freight futures AM update. Dry bulk, Capesize, and Panamax are both up 1%. Tankers, VLCC's down 2%. Suezmax is flat. Coming down, we got HFI Research. EIA reported a minus 9.3 million barrel oil draw. And again, HFI Research says final crude estimate for September 12th week, we revised U.S. crude oil production to 13.75 million barrels per day. We don't think EIA will be more bearish than our crude storage figure. And there it is, minus 4.86 from them. And the real number was minus 9.3. 9.3 is a massive number. I mean, that is a massive draw. Jeez. Coming down, QE Infinity. Boomers are the worst, most entitled generation ever. They are the main reason why we got where we are today. I'll die on this sword. Just awful. What's going on here? Almost 3/4 of boomers, 73%, say they value stability in their community over affordability for younger generations to move in. Meanwhile, 59% of boomer homeowners would vote for a political candidate who prioritizes protecting home values, even if it meant fewer people could afford homes. Well, I mean, I'm in the middle there. So this is what I mean by I'm in the middle. I don't. There's certain areas where I purchased where I don't want low cost housing to go. So if I had a choice, I would block all the low cost housing in my area because there's no low cost housing here to begin with. So there shouldn't be any, there shouldn't be certain developments in certain areas if there was never any to begin with, so to speak. So you don't plop low cost Section 8 housing next to $1 or $2 million area homes. I chose a certain area because I wanted my kids to go to school with certain other kids. And what that means is I want the kids to be motivated where other kids are looking forward to going to college or starting their own companies, which deals with the demographic uh, of certain socioeconomic, status levels. Now, some people will say, "Oh, that's absolutely horrible, Andy. Why would you do that?" Now, it's called being smart. Um, the schools don't make the kids make the school. So smart kids going to school makes the school look good. And that's kind of my opinion. And the kids that my kids hang out with are going to be influenced by their decisions. So I am influencing my kids' outlook and the kids that they potentially could hang out with based off where I live and where they go to school. You might have to listen to that 2 or 3 times. Hopefully I said that correctly. So if I chose a certain area, I did it on purpose. Now, if they started to put in um, different types of homes in the areas that I live in that I don't like, the people moving into them, I would have to move. So would I block them? Yes, I would, because I don't want those people to move in. I mean, I don't know. It doesn't make them bad, and it doesn't make them that most entitled generation ever. I mean, it's just reality. It's what it is. Jesse Colombo says the Fed is playing with fire by cutting rates, risking the creation of massive bubbles in tech stocks and cryptos. We'll know a major crypto bubble has begun when the global 30 crypto index breaks out of its cup and handle pattern here. And that's for crypto. The global 30 crypto index could potentially be breaking out with all this liquidity that is in the markets. We've got gold versus platinum, or platinum to gold ratio is what this one is. It says no breakout yet, but getting closer. We've got a falling wedge that's ready to break out. We're flagging. That's a little flag pattern there on the ratio. And those generally break higher. And then Rock Bottom says gold is passing the baton to PGMs. Platinum and palladium outperform from here, in his opinion. And I would say that we are entering that at any second. I would agree with that. Platinum generally outperforms gold under inflationary conditions where there's no kind of safe haven bid. So the baton gets passed to platinum and palladium, and the ratios support that. The charts support that, and a lot of the inflation sensitive sectors are starting to bottom and move higher. So yes, I would agree with that. Another one from QE Infinity. The bond market has completely rejected the Fed's rate cut. Yields have ripped higher following an initial drop on the rate cut announcement. The rate cuts had the exact opposite effect of what the Fed wanted. Mortgage rates will now spike. I don't know if that's going to be the case, but we are seeing the 10-year move up a little bit. I don't know how sustaining it will be. I'm going to remain an open mind here. I'm going to have an open mind here and see how this plays out. I'm not going to take one side or the other. I'm just going to watch the charts, see where it goes, and see how the market digests all of it. If rates go up, we know we're in an inflationary environment. The bond market doesn't like it. So I win. If rates go down, we're going to get more inflation from the real estate market in terms of loans coming into the market. So we're going to get more monetary bank lending, which is inflationary. So we either get inflation today or inflation tomorrow. I like it. I like my odds. Tavi says no one seems to be looking at this, but energy stocks continue to make a move. Quiet breakouts are always more powerful in his view. And here we are breaking out of a downtrend in energy stocks. And it also has that fractal that gold and silver had before they broke out. So it looks very promising here for energy stocks to start moving up. Very promising. And that's all I've got for today because I went over that last time. So we're going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials the coupon code. And that's all I've got for today. So we'll catch you next time, guys. See you later.